Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-hosts for Upticks.
Today is our 31st episode. Your account is on fire.
We're going to talk about expanding your financial plan, questions worth asking, and why the market's on fire.
Okay, Corey, to kick off our financial planning portion of our show today, we wanted to talk about expanding your financial plan. And so with all of our clients, we typically lead with a retirement goal. That's why the majority of people in America invest in the markets. But you brought up in our intro here that you wanted to talk about expanding that. So what do you really mean by that?
Really what I'm talking about is making sure that if you have a financial plan or a retirement plan, either piece in place, I guess it's one and the same, but making sure that you're in your financial, being in your financial welfare, that you're addressing more than just here's my retirement goals and here's my investment allocation, because there's a lot of other things that should be considered. Okay,
so maybe you can cue in, or maybe you can clue in our audience here as to what other types of goals maybe you work with your clients as far as investing.
Sure. Well, I guess starting at a high level as far as other goals, I would say, one of the most frequent goals that we come across is, extra spending in retirement, usually for something like, traveling, for instance. Maybe it's buying a second home. It's fairly common that people want to talk about sending their kids or their grandkids to college and paying for it, or at least paying for it in some capacity.
And what about healthcare?
And healthcare is another one, because obviously the environment that we're in right now, if somebody's retiring before Medicare age,
what is that age?
65.
Okay, so if somebody leaves their employer and they're 60 years old, and their employer doesn't offer for them to stay on their health insurance, typically they'll get COBRA, right?
Correct.
And COBRA basically is a bridge of 18 months where you typically can stay on your company's health insurance. You'll probably have to pay a little bit more than you would as an employee.
Right.
But you would be able to be covered. And so,
for what it's worth, in my experience, and from what I've gathered, is that historically people have thought that COBRA is a really expensive option. But I think in the healthcare environment that we're in today, more often than not, I know that there's been professionals that are in healthcare that have recommended clients get on COBRA. Even though they've thought all along, well, COBRA is really expensive, they've gotten the professional advice. Well, a lot of the times COBRA is still a better bet than you might get on the healthcare exchange.
So what you're suggesting as part of our planning is that we'll typically have a core goal of, let's say, $10,000 a month. And that's an after-tax number that our client may or may not need to spend to pay their mortgage if they have a mortgage, to go out to dinner, do some domestic travel, or whatever that may be. But what you're saying is that maybe on top of that, we add in health insurance premiums until they turn 65. Now, certainly Medicare is not free, but that's definitely something that we can help our clients plan for.
Yes.
You also brought up travel. So what do you typically do in a financial plan when a client wants to take some vacations?
We kind of try to talk through what that's going to look like, because I think that, I want to travel more when I retire is a really common goal that people have, but I don't know how much, thought or energy or effort people have put behind, okay, well, where do I want to go? How frequently do I want to go there, and what's the cost? So a lot of the times, people will start with, for instance, $10,000 a year as a goal for travel. And, whether that means you want to, take an international trip, that might be one trip that year, and it might be more than 10,000. It depends on where you go. Or it might mean that you want to take several long weekends around the United States.
Where cruises are really popular.
Cruises are popular too, and that allows people to go travel more frequently.
Gotcha. So to kind of compartmentalize our goals a little bit. So what you're suggesting is someone would have a $10,000 a month primary goal. Let's say they're 60 years old.
Yes.
And then for 5 years, we'll have a health insurance goal of, $1,000 a month or whatever that is. And then you might put on top of that another travel goal of, let's say, $10,000 a month. And do you typically do that forever, or do you do that for a finite amount of years? Or how do you normally guide clients along that path?
Generally speaking, I would say, for X number of years earlier in retirement. I know that we have a handful of clients I can think of off the top of my head that we assume that goal is in perpetuity. Now, realistically, whether or not that happens remains to be seen. But from a comfort standpoint, I know that clients like to see that built in, but I think most people approach it from the standpoint of, well, if I'm retiring at 62 years old, my travel goals in terms of the dollar amount that I'm going to need to spend is probably not going to be the same when I'm 85 as it is when I'm 62.
And didn't you write a blog series about this, and it's called the Go-Go Years?
Exactly.
Basically, that's when people typically retire in their 50s or 60s, you've got a lot of energy, and you do want to take some of those big trips that you maybe have been putting off because you have been busy in your career. Or maybe you want to take your grandkids to Disney World and pay for it for everybody. And so what Corey and I like to do is we're comfortable front-loading some of those spending goals in the beginning because we feel like we're not particularly adding any value if you're 90 years old and you've got $10 million, but you never got to go to Disneyland or on a cruise or Europe or whatever that may be important thing.
Or even just helping, family or children out. I had a good conversation with a client just the other day on Thursday who had mentioned to me, they said, if I'm going to have X amount of dollars when I'm 90 years old, what good is that going to do my daughter when she's 50 or 60?
Right.
That child needs more help and would not appreciate it more, but could probably use the help more now. And I would get the benefit of being able to see them, enjoy what kind of the fruits of my labor and what I'm able to provide to them. So I think that's a common thing that we talk about with clients too, is kind of giving over their life as opposed to just their kids inheriting a big chunk of money after they pass.
Yeah, that's a really good point. And I talk about this a lot with our new clients, is that spending will normally look more like a bell curve in retirement. Those early years, you'll spend more. You'll do some of those big major expenses. Then it'll start to flatline out a little bit. Again, we just run out of energy as we get into our 70s and 80s. It'll go back down and then maybe flip back up a little bit at the end because you're going to the doctor all the time. But the idea is that we want to carve out those goals early. And ultimately, we're just here to make sure that the capital that our clients have accumulated allows them to do the things that they want to do without ever running out of it.
Exactly.
And that's really what we're talking about when we're looking at expanding your financial plan. And so some of our clients will have several goals, right? So it might be that core goal. It might be health insurance. It might be travel. Their kids might not be married yet, so it might be weddings. It might be a Corvette. It might be a second home. It might be starting another business. I mean, you can go on and on and on. And that's part of the enjoyments of our job is basically to have those conversations with our clients and show them what they can afford on the front end of things to make sure that they don't run out of money, 30, 40 years from now, however long their plan is estimated.
That's right. And the other piece that I wanted to add to that as far as expanding your financial plan goes is how we address kind of those being the pieces of a plan that it's predicated upon. What I was thinking about too was how I had read an interesting piece earlier this week about how if someone has a financial plan, and it might be different for somebody who is 45 versus someone who's 62.
Right.
But if somebody's younger and still has more years to work, that making sure that their financial plan addresses needs beyond just what their retirement goals are. In other words, thinking about, are you covered as far as life insurance goes? Are you covered as far as your emergency savings funds goes? If an emergency happened, if something that was
disability
insurance, or disability, that's another piece. So the reason that I bring that up is your financial plan, in all likelihood, depending on where you're at, should address all of those things.
That's a good point.
That you're covered.
And to echo that a little bit also, if we define separate goals for clients, that also means that we can change the asset allocation by goal.
Good point.
And the reason, again, at Falcon Wealth Advisors, we're building out custom portfolios comprised of stocks and bonds and cash if need be. And so we can, have a wedding goal, and maybe your son or daughter is going to get married in a couple of years. Well, that pool of money might be a little bit more conservative than something that you're looking at 20 years from now or 30 years from now, whatever that may be.
That's a great point.
So we can also adjust the allocation dependent upon the goal. And really the takeaway from this segment is that if you're working with a financial advisor and they're not spending time to talk about planning with you, we feel that you're getting a disservice. And certainly with our clients, we make sure to update their plans at least twice a year. And then we also talk about expanding them and adding more goals if that's the case. Now, not every client needs it, right?
Correct.
Some will say, $10,000, Jake, that gets it done. That covers my health insurance. That covers my month-to-month bills. That covers traveling for me and my spouse. So I don't need you to break it out a million different ways. And that's fine. That's certainly fine.
Yep.
But what we wanted to point out today is that don't be scared to ask, hey, I want my financial plan expanded out a little bit. I want to talk about my goals in a little different way rather than lumping them all into one monthly number.
Exactly. And to the point you made as far as having different allocations or different investment strategies depending upon what each goal is, that you bring up the great point that for our clients, we want their financial plan to dictate their investment strategy.
Exactly.
In other words, we want the investments to be the fuel that allows the plan to kind of drive and go.
That's a good point.
Not the other way around.
Right. Yeah. And if you're investing without a financial plan, then you're just speculating. I mean, it's really, if you don't know exactly what that money needs to grow to be, to solve that problem or spend the money or whatever you want to do, then you're almost wasting your time investing. In my opinion, you've got to have that plan dictate what needs to happen, and then we can back into it and figure out what does the asset allocation need to look like.
And that's why we're so adamant that some of our clients or even prospective clients might think. That's why we're so adamant about wanting to have a conversation around what your goals are before I just say, oh, let's go invest your money this way. And
right.
Let's try to understand what you're trying to accomplish with this money first.
Yep, absolutely. It's a great point. Okay, good. So we covered the financial planning portion. Let's move into questions worth asking. So why don't you fire away first and ask me the question that you had for me this week?
Sure. So we were talking, before our introduction today, and what I wanted to ask you about is we've mentioned how 2018 was not a great year in the market.
Right.
Depending on how people look at it, we'll probably define it as a bad year. My question for you, Jake, is if I'm your client, what are you doing after a bad year? Are you changing your strategy? Are you sitting on your hands and trying to let things work themselves out? Are you hoping for the best? What are you doing?
Thank you. That's a really good question. And so, at Falcon Wealth Advisors, because we are managing the assets in-house and we're not using a third-party mutual fund or index fund or annuity to do that, we're constantly looking to improve on our process. And so we take that very seriously. And so actually right now, for 2019, we are in the early beginning part of testing out a new strategy that would be in addition to our current stock allocation. Actually, we're looking at the stocks and the fixed income piece. And so what we're doing is for our clients that are viewing in, and we'll probably talk about this on a future show, is that we use a Kalan chart to basically dictate our asset allocation. What we're looking at is using that same chart, and normally we stay disciplined as far as to what boxes we stay in and the weightings. We're looking at drifting within those boxes based on macroeconomic indicators. And so without making this show, go ahead.
I was going to say, what does that mean?
Yeah, it's making the show a little too complicated, but the idea is, to answer your question, yes. Obviously, nobody was happy with the market returns being negative. And so what we're doing is we're taking our current portfolio with our clients, and we're still using that, our strategy that you and I learned from the University of Pennsylvania's Wharton School. But we're basically testing another one side by side, not on a broad level. We're not rolling that out to all of our clients right now. But what we're looking is that if we can get a little bit more tactical in our weightings, can we help protect our clients or maybe make some more money back as things bounce back here? And so we don't believe in just telling our clients just buy and hold and it'll come back up. It always does. I mean, to some extent that could be seen as true, but we're constantly looking to improve our process. In fact, early in our careers, we were taught just to put everybody in products.
Exactly.
Right? Like salesmen or brokers. And that's the way that I learned over 10 years ago. And that's the way that I know that you learned as you and I started forming our partnership. And we learned that was wrong, in our opinion. And we don't like just charging people a fee and then putting them in a product that charges another fee, and then we don't have any control. But it took us time to understand that, and we didn't make any knee-jerk reactions. We're very methodical when we do make changes on our team, and we certainly test things out very thoroughly before we roll them out to clients on a broad level. I know that's a long-winded answer to your question, but to answer it, yes, we're absolutely looking at our stocks and seeing if we can get a little bit more tactful in the short term. We're also looking at some other fixed income opportunities to see if we can create more income for our clients down the road as well.
That's good. I guess I was thinking, while you were kind of explaining yourself there too, one other question that popped into my head is, if I was thinking about how obviously we don't use products, right? We're not using mutual funds here for our clients. But if I am an investor and my financial advisor is buying me mutual funds, is my advisor going to have any idea what that mutual fund manager is doing after a bad year?
No, probably not.
What their strategy or goal or target is?
No, typically no. I mean, the advisor can look it up on Morningstar or call the fund company and try to get some information. Typically, they do publish their top holdings, but not necessarily all their holdings. And again, that could change day over day. So the advisor might get an update, but that could change as soon as the market opens the next day. And so that's, again, that scares us. I don't want my clients who trust me and you and the rest of our team to manage their capital not knowing what they're invested in and why they're invested in it. There's some pretty bad mutual funds out there, frankly. I mean, 80% of them underperform the market. So an advisor that's using mutual funds is just playing a fool's game. I mean, because ultimately, their guess is as good as the client's guess into which fund is going to do well. And because they don't have control or know what's going on, it's silly, in our opinion, for an advisor to use products.
And if 80% of those funds are underperforming to begin with, probably there's another percentage of those funds that are going to underperform even worse after an advisor's fee is deducted.
Yeah, I don't even know what the study shows on that, but you're right. That's a good point. Those are before the advisor slaps on their fee on top of the mutual fund's fee. So a typical mutual fund might charge approximately 1%, and an advisor might charge 1%. So you're negative 2% out of the gate every year before anything happens. And that's a big... Yeah, we're talking that's a lot of money. I mean, on $1 million, that's $20,000 a year in fees that you're paying before the market does anything.
Right.
So
that is a lot of money.
Yeah. So again, we're not going down the product road at all. Again, our clients typically have enough assets to buy stocks and bonds individually, and we want to do that for them, and we want to know exactly what's going on and why.
And I think our clients, at least from the conversations that I have, like the uniqueness of our transparency about who we are, what we're doing, and why we're trying to improve upon things. Yeah, but ultimately, we're the ones that are making the decisions. Yep. Therefore, we can speak to what we're actually trying to accomplish.
Yeah, absolutely. Yeah, I think any advisor that's taking their profession seriously should be taking ownership of those assets.
Agreed.
Yeah. All right, good. So I've got a question for you.
Okay.
I wanted to ask you, because this comes up, I don't know how often it does, but I think a lot of people would ask this that are watching our show, is when should someone come talk to you and I or our team about investing with us? We talk a lot about retirement planning, and both of us are chartered retirement planning counselors, and that is our niche or our specialty. I guess whatever you want to call it, but that's where most of our clients come from. So when should someone come talk to us?
So this is a very attorney answer to give, but the first thing I would say is it depends.
Right.
But with that being said, the idea is, at a high level, with you and I being chartered retirement planning counselors, like you said, I would say that typically the most value that we add is if we're meeting with somebody who's planning on retiring within the next 10 years, or even if it's somebody who's recently retired. Now, that being said...
So it's normally someone probably around in their 50s or older?
Yes, typically. Okay. I would say that most frequently that's the case. Surprisingly, still, it seems like a lot of people that we meet with and new potential clients that I meet with are closer to retirement than that. And it's not uncommon that, I'm sure you've heard this too, that people say, well, I wish I would have started planning sooner. And that's okay. There's nothing wrong with that. The point is that that's usually where we can add the most value is, usually somebody who's probably 50 or older.
Right.
But with that being said, it doesn't mean that somebody who isn't 50 shouldn't be thinking about planning for their future, right? The idea is...
Well, real quick, just to back up a little bit. So if you're saying somebody in their 50s or within 10 years or so, why would that be? Why are we... focusing on that for our clients?
Because if someone is at that point in their life, they have probably started to think about what their retirement actually looks like. And if they haven't, we know some of the questions to ask to help them get to thinking about it correctly.
So based on the research and the studies that you and I have, or the studying that you and I have done,
yes,
that's when they're going to get the most value added from us.
Yes.
Again, so we focus a lot on income. And somebody in their 20s...
That's also a good point.
Yeah, income might not be as important to their portfolio because they're still accumulating assets. Our clients want income from their portfolios, and so that's a big part of what you and I have studied.
Not to mention the fact that if somebody is 5 to 10 years away from retirement and they have their portfolio invested, maybe their 401k is, the far and away the largest chunk of money that they're going to have for retirement, which is the case for a lot of our clients. Yeah. And that their 401k might be not invested at all in a way that aligns with what their plans are for retirement.
Right, that's a good point.
Meaning somebody who says, I want to retire in 5 years, but I have 100% of my 401k in the stock market.
Right, that's dangerous.
It's better to have that conversation and talk about how to allocate that now versus the day before you retire.
And I think to your point that you were kind of going down also is that as people get closer to retirement, they're able to pin down some of those variables.
Exactly.
It's hard when we sit across from somebody that's younger and we ask them when they want to retire, and they don't know. A 20-something-year-old's probably not going to know. They might say 50, 60, or 70. I don't know. Or They don't even have kids yet, right? So they haven't even had children, and so they don't even know what that looks like, or they haven't even bought a first home. So again, Corey and I, you and I have studied a lot about people approaching the life cycle basically of retirement, because we know about income. We talk about Social Security. We talk about Medicare. We talk about all of those things, and we focus a lot on that. But we do have a third advisor on our team, James Lewis, who does work with younger people. So maybe you can talk about what kind of services he can help some of our younger clients.
That is exactly what I wanted to talk more about next. The idea is, with James working with us and, working with us for several years now, and, working with clients and managing those relationships, he does work with some of our younger clients. And when I say younger clients, that might mean someone who is 30. It might mean someone who's 40. It might be a child, a client's child that graduated college recently, and if nothing else, just wants to know how to start planning, saving for the future.
Right.
And the idea there, though, is because we have different tools like our robo-advisor, for instance, Flight that we talked about last time, and solutions that might make sense for those people. But it's not uncommon that even if somebody's, if they're 30 years old, they've been working for a couple of years, maybe they've been promoted once or twice, and they're starting to make a little bit more money, they're thinking, all right, well, one day I would like to retire. I don't know what day that is. I don't know what my life's going to look like then, but I do know that I don't want to work forever, and all I've done thus far is just save money. But I don't know how much I should be saving or what it looks like. So I think to kind of tie a bow on that, I think the point is anybody who is thinking about wanting to retire one day or is thinking about how should I have some discussions at a very high level even about retirement and how I should start saving for that now, should come and talk with us. So if somebody's 30 years away from retirement, or if somebody is 5, if someone's 25 years old, or if someone's 75 years old, if they want to talk about their retirement, they should come talk to us.
Right. That's a good point. And maybe to kind of, like you said, sum up that conversation, also people that probably should not come talk to us, to see the other side of that question, would be people that are looking to speculate. Maybe they want to buy Bitcoin or something off the wall, or some weird alternative investment. Or put all their money, in gold or something like that. That's not really the type of clients that we work with, because we don't believe in those things. I think somebody was looking the other day to be referred to somebody that would sell them an annuity, and I don't believe in annuities so much. I said, I'm sorry, I don't have anyone to refer you to, because I don't
think you should do it.
Yeah, I don't think you should do it. So I'm not going to tell you to go buy something from somebody that I don't necessarily trust or don't have confidence in. So again, if you're looking for products from us, we're not going to do that. If you're looking for us to sell you something like a broker would at one of these major banks, we're not going to do that. So again, we're fiduciaries. We're going to act in your best interest. We're not going to use products. And before we invest a penny of your money, we're going to make sure that we have a goal attached to it, or some sort of idea as far as a target at least is concerned, to help that capital achieve what it's supposed to do.
Exactly. I'm glad you said that, because it isn't I talk about anybody who's planning for retirement. That doesn't mean that we're a one-size-fits-all shop,
we're not.
right? It just means that those are the people where we can add value and ask the right questions and get them thinking about it. But I've met with people before that said, hey, I want to write you a check for $50,000 and I want you to go buy me XYZ
or
stock.
Play in the market.
Yeah.
We don't do that.
That's not what we do.
Yeah,
I don't want to play with anybody's money.
Yeah, no, we don't do that. This isn't Monopoly or a game that we're playing. It's no, we want to invest your capital, tie it to a goal, and help you reach that goal.
Exactly.
And that's what we do. And primarily it's retirement. You're right. Because that's where you and I just happen to spend a lot of our time studying and focusing on that and helping people retire. And that's what we enjoy doing.
Yep.
Okay, good. So to our next section of the show, we talked about how the market's on fire. So why don't you talk to our audience a little bit about what's happened here out of the gate? We just wrapped up, we're a couple weeks into the year almost here. And why don't you tell people what's going on?
Since Christmas Eve, which is when the market kind of bottomed, at least here in the short term, that the lowest that the level that the market hit during this correction that started back in the fourth quarter of 2018 was on Christmas Eve. And since then, we've seen the market bounce back over 10%. Almost crazy. Over 11% in just a couple of weeks.
So it was down almost 20% starting in the fourth quarter, I guess. So around the third quarter it peaked.
Exactly.
And the market tanked, around 19%. And you're saying since Christmas Eve it's already bounced back up almost 10?
Yes.
Wow.
Which one, I was having a conversation with Jesse.
Who's Jesse?
Our analyst here.
I just want to make sure.
No, it's okay. So Jesse,
I know who Jesse is.
I know you do. So we were talking the other day, though. I said, imagine trying to time the market.
Right.
And imagine, on Christmas Eve when, I mean, I remember watching, CNBC or whatever, and the market was just selling off, and it accelerated and accelerated. And fortunately, it was a half day, so it was over with at noon. But if you tried to time that, and that's when you thought, okay, this is just going to get worse, and that's when you decided to get out, boom, in just a couple of weeks, you would have missed 10% back up on the ed side.
Yeah, and so if you're talking about $1 million, that's $100,000 of bounce back. Or if you have $500,000, that's $50,000 your account.
In stocks,
In stocks, at least, right? The bonds would be a different story. But, I mean, that's just crazy. So that again, that's a good point. You can't time the market. And it's a fool's game trying to get all the way in or all the way out.
You totally miss it.
With our clients, we just use math. We rebalance when the numbers tell us to. But we're definitely not trying to jump all the way in or all the way out. I guess some of the so maybe you can explain to our audience some of the reasons why we feel that it's bounced back 10%.
Right. So there's been a couple of reasons. One is the sell-off that occurred in December, which was the brunt of the sell-off in the fourth quarter of 2018, was due to the Federal Reserve and people's concerns that interest rates were going to be raised to a level higher in 2019 than the economy could handle.
Right.
Since then, there's been certain people that are part of the Fed, along with Jerome Powell, who's the chairman of the Federal Reserve, who have all come out and said, you know what, we're going to be mindful of economic conditions and market conditions before just kind of going into 2019 and blindly raising rates because that's what we think is right.
Right. So they've been more accommodating, and the market likes that.
And people, yes, exactly that. I think the way to put that in simple terms is they've said, okay, we're going to pay attention to what's going on. And they say data dependent is their term, meaning they're not going to just go and do something no matter what. They're going to be open-minded to what the market allows for. And it's kind of like at the beginning, if you remember, at the end of 2015 into the beginning of 2016, when the Federal Reserve just started raising rates. They raised them one time in December of 2015, and they planned to raise them 4 times in December in 2016. And the market sold off in the beginning of 2016, and they didn't end up raising rates again that year because they realized
it was too much
after
too
the
soon.
fact that it was too much too soon. So at this point in time, the Fed just wants to be cautious.
So the Fed's
investors want that.
So the Fed's being more accommodative. Is there anything else?
Yeah, the other one has been the trade talks between the United States and China, which are obviously dominating the headlines right now. It can get to be exhausting to some extent, but we've at least the perception of those talks is that they've made some traction. They're getting closer to a resolution. What that looks like when it comes, I don't know, but investors have interpreted that as a positive. Because the expectation is on a macroeconomic level, it'll be a good thing once a dispute that is resolved.
Makes sense. And I think the third thing that we're probably going to start paying close attention to is that we're approaching earnings season.
Yep.
Hopefully if earnings for companies come out and they surprise on the upside, you typically get a nice little rally when that happens as well. So we'll be paying very close attention to earnings as they come out.
And it's just, it's funny though how sentiment can change so quickly. It went from, everything's awful and the world is ending to, maybe things aren't so bad and the market has room to run.
Yeah,
somehow, some way, people's minds it's because we think linearly.
Right.
When it's going like this, we think one way and vice versa.
Yep, and things cycle. And so again, that's a good takeaway is that things were tanking in the fourth quarter and you can't get out because if you get out when it's bottoming out, you miss these nice bounces. Even if the market pulls back again, it doesn't matter. I mean, the ideas of the stocks for the long run here, they tend to go up over time, and so you don't want to try to jump all in or jump all out. It's just very dangerous, and if you get it wrong, you literally could cost yourself and your family thousands of dollars. And
not to mention any money that you have in the stock market should not be money that you're going to need in the short term anyway.
Good point. It's kind of like the value of your house. And I think I've talked about this before, is that if you're planning on selling your house in 10 years, do you care what the value of that house is today?
No, really.
It doesn't matter.
It doesn't impact you, at least.
Exactly. It's same with the stock. So the idea with our clients is anything that they need to live off of in the short term, we want to have in bonds or cash. So again, their stocks, while it frustrates them when they go down, it doesn't really ultimately hurt their financial plan. As long as you're not selling when those stocks are down is the whole key.
Do you care to make a prediction for the stock market in 2019?
No.
Okay.
No, I'm not going to do it. Do you? I have no idea. I mean, after it was up 20% roughly in 17 and down, depending on which number you look at, around 6 and 18. There's no telling.
Yeah, okay.
But I'm just going to stay. We're going to stay nimble. We're going to continue to improve our process with stock picking and buying individual bonds for our clients, and continue to improve on that.
Good answer. I like that.
So no,
I don't want to make a prediction either.
No, I'm not going to make a prediction. But speaking of predictions, And please forgive our casual attire today. I didn't mention that at the beginning of the show. We're filming this on a Sunday. The week kind of got away from Corey and I, so we came in this weekend to do it. But here recently, the Chiefs won their first home playoff game in, I don't know, a really long time.
Yes.
So
I think 25 years.
Yeah, so they just beat the Colts. And as of the as of the filming of this show, I think the other AFC teams are playing right now. So I first wanted to get your take, Corey, on who do you think the Chiefs will match up the best against, and what are their keys to maybe going to the Super Bowl? And you got your Chiefs polo on, I see.
That's right, yeah. So, first and foremost, I was watching the game yesterday. I was just shocked that the defense played as well as they did because it looked like a completely different team from what we had seen.
And did they win the turnover battle like I predicted? Or I suggested?
Yes, they did. Oh, yeah.
Okay.
Yeah, they did. But as far as...
What do you think caused that? Why do you think the defense played so well?
I don't know.
What changed?
You know, one thing that I didn't really... I guess it was my own ignorance, but I realized because I saw some people tweeting about it and I read a little bit more about it last night during and after the game, is that if you look at the 2018 season, the defense played dramatically better at home. Yeah, I heard even throughout the regular season.
I heard the announcers say that.
Which I don't think I quite realized.
And don't they have some younger players in the secondary now?
Yes.
They benched some of their veterans, right?
They made some changes.
And I think those guys stepped up.
Yes.
Because Andrew Luck, I think he was the second best quarterback this year, right?
In terms of touchdown passes, yes.
So you're sitting here playing a guy that's obviously had a great season. I think the Colts won 9 out of 10 games or something ridiculous.
Yeah, 10 out of their last 11 prior to yesterday.
Yeah, and so for our secondary to shut them down like this, particularly in the first half, I don't think they got a first down.
No.
In the first half.
And they were 0 for 9. The Colts were on third downs. Which I read this morning that the coaching staff and everybody attributed the team's success. They said the story of the game was the Chiefs' defense on third down.
Yeah, makes sense. Okay, so we don't, as of the filming of this show, we don't know who they're going to play. It's either going to be New England or it's going to be the Chargers, LA Chargers. So who do you think the Chiefs match up best against? Or who would you like to see them play?
You know, I think the answer to both of those questions is probably the Patriots, believe it or not. Now,
really,
it's probably naive to say that, you know, to want to face the Patriots in January. But I do feel like at this point in his career, Tom Brady and the Patriots are not nearly as good of a team away from Foxborough as they are at home. I feel like the Chargers are a team that have kind of been, you know, road dogs for the lack of a better term all season. Chargers have won their best games on the road. No one else has really done that, and they don't even really have a home crowd because only the people in LA that really care about football, it seems like, all decided to be Rams fans. So the Chargers, even when they play at home, it's like they're playing on a neutral field. So they're much better. They're going to have less of a home field advantage than the Patriots will. So theoretically, their splits between how well they play at home and away is going to be less dramatic than the Patriots.
It's cold in Kansas City right now, though. So don't you think I guess these players come from all over the country when they sign up for these NFL teams. So that doesn't say everything. But I mean, New England, they play in the cold weather. It's Tom Brady.
I know. But so here's the deal.
So you take Phillip Rivers over Tom Brady
that is not what I said.
To take his team to the AFC Championship game you just did.
What do you mean?
You think Phillip Rivers' team will beat Tom Brady's? No. Sorry, you didn't. You flipped that. You think the Chiefs will match up better against Tom Brady?
Yes, and
because you think the Chiefs can beat Tom Brady, I guess was where I was going with that.
Yes, but
over Phillip Rivers, you'd rather Mahomes face Brady than Phillip Rivers. I guess is where I was going.
Not because here's why. Okay. So I have to explain this also because I think that seeing Mahomes and the Chiefs beat the Patriots at home, I think it would almost be symbolic to see Brady lose on the road in an AFC Championship because I think the era of Brady and Peyton Manning and Ben Roethlisberger and those guys is coming to an end in the era of the Baker Mayfields and the Andrew Lucks.
But wouldn't you rather see the Chiefs play Phillip Rivers? Don't you feel like we could beat Phillip Rivers more than we could beat Tom Brady?
I don't know. The Chargers are a pretty good team. They're a pretty good team.
And didn't they beat us this year one game?
They came back and beat the Chiefs on that. It was
at home at Arrowhead.
It was a Thursday night game.
Yeah, because we beat them opening day.
Correct.
In LA. I don't know. I don't think Phillip Rivers has that it factor to take his team to the Super Bowl. I just don't. No matter if it's the Chiefs or who he's playing.
I think it's going to be a moot point, though, because before we started filming this, in the first half, the Patriots were already winning 28-7.
So you think it's going to be Brady? I think
it's going to probably be the Patriots anyway.
And do you think, okay, so moving on with that, do you think the Chiefs can beat the Patriots and nearly go to the Super Bowl?
If they can show up and look like that, if they can play the way they did yesterday.
Didn't we beat the Patriots earlier this year?
No, they lost. That was their first loss, but it was like 44-41.
Very end, right? Very end of the game, I think.
But last year the Chiefs dominated. It was the home opener, but last season the Chiefs, I guess that was totally different anyway, but they dominated the Patriots
at home
in New England the opening week last year.
So we played them back-to-back in New England 2 years in a row?
Yeah,
I think you're right. Yeah,
correct. Yeah, that's right.
And didn't New England win on the last second field goal or something? It was that close of a game this year.
It was
right?
like a 3-point game.
Yeah, so I'm hoping they win. Obviously, do you have a score, a prediction? I know we don't predict stock market, but do you have a game score you want to throw out there?
If they play the Patriots,
yeah,
it'll be a high scoring game. I think maybe
even with our new defense.
Yes, I still think it would be something like 35-28 or 42-28 or 42-35, something like that.
Do you think Eric Berry will play?
I have no idea.
Yeah, I think
Hopefully.
it was huge that Sammy Watkins played. Even though he had a fumble, I know we turned the ball right back over right after. But I mean, I was good to see him in the game. I think he made enough good plays that it's definitely. I hope he's still healthy and can play. But I think if Eric Berry plays, I think we'll have a really good chance. I think we need him against Brady. Just the way I think he surveys the field.
You're probably right.
Would help. Obviously, it's not going to hurt. And that defensive line.
They looked good.
They looked really good. So it'll be fun to watch.
I think they kicked the curse, though. They won at home. So I think that the baggage that everybody has been hanging on to for so long is gone now.
Well, I think
it's just can't win.
I think it's a sign of just a younger team. I think it's Mahomes. I think he didn't feel any of that pressure.
No, I don't think anybody did.
And I think he's handled it extremely well. So
because there was one point in that game when the Chiefs had that punt blocked and the Colts scored, and everybody kind of collectively was like, "Uh-oh." But then that was it.
You're right. And then they marched down the field, scored. It's like it never happened.
Yeah, exactly.
And poor Adam Vinatieri, man. Maybe it's time for him to retire.
I think so.
That was kind of sad. How old is he? 45?
I think he's 45 or maybe even 46.
Good for him.
Yeah.
That's quite the NFL career.
Playing, I know.
46 years old out there. But I was surprised he missed. It didn't matter, but
it could have.
It definitely could have. I'm surprised they would have someone like that on their team. Maybe he was good all year. He was good all year, wasn't he?
Yeah, I think so.
So, anyways. Well, all right. So, again, as of the filming this, we're not sure who we're going to play. We think it's going to be the Patriots. Go Chiefs. And
that's right.
As always, thank you for tuning in to our show. We're definitely out there in social media. You can find us on Twitter, Instagram, Facebook, LinkedIn, and, of course, this is our YouTube channel. Please tell your friends to subscribe and to like our content. And if you want to hear anything else, always feel free to give us suggestions. You can find me on Twitter at JakeFalconCRPC.
And I'm on Twitter at Corey Bittner KC.
Thanks again for watching, and we hope you have a great week.